Hey, welcome back to Watch Your Six. As you all know, I'm Jason Edwards. We're delighted to have you here. Hopefully you've enjoyed our podcast and some of the information we shared. And remember, our focus is really try to provide you information and give you insight on things maybe you didn't think of. The premise of Watch Your Six is having an individual group of people that help watch the things that you're not necessarily looking at to protect you from the unknown. And it's always designed to really help you invest and become wealthy or successful in whatever goal you're trying to endeavor in, but minimize some of the mistakes that can be avoided. Now, traditionally, there's things that are going to happen, whether you're starting a business, whether you're an entrepreneur, whether you're an executive trying to save for retirement. There are things that you cannot avoid. But what we found is there are a lot of things that can be avoided with proper planning, proper education, good insight and information. And what we hope to do every week on these shows is to try to give you that information, but do it in a way that's easier to understand. One thing I find about this industry is we have a propensity in our world to talk over our clients. You know, we sit there and pontificate and use big words and really get very technical, and our clients get sort of overwhelmed, and then they just don't want to ask questions, or they don't feel, like it's appropriate, or they may feel like, it makes them look a little inefficient. So we want to make sure that you're understanding the dialogue and information we're sharing in a way that you can then implement it. And if you have questions, we always recommend you to DM us, send us an email, go to our websites or our social media links, and we'd love to have those questions or situations come up on our future shows. Therefore, we can give you some insight. Now, you have seen in the market recently what's happened. And if you've gone back and looked at our podcast, you'll see that we told you that was going to happen. Now, again, there's no guarantee of future forecasting, but we had a pretty good barometer of what we see transpire in the marketplace, even though many of our counterparts or individuals that do the same thing we do have said the opposite. They said the sky was going to fall, inflation's going to go through the roof, the market's going to crash, and none of those things have come to fruition. That is a good thing for you if you have a 401k, if you have an IRA, if you're working 9 to 5 and trying to save a little money for kids' education. These are all positive things we're seeing economically, and we feel like a lot of that's going to continue. But there are things that we're going to teach you today's episode that can really help you improve or magnify your growth. One of the biggest things that will dwindle down someone's growth or their assets is taxes. If you don't think that's the case, look at your tax return. You make all this money at the end of the year, you see your W-2 and you find out how much was withheld or how much you paid. So whenever you can minimize or mitigate the tax impact to your investments, that's a win. In fact, many money managers will tell you that's the most productive and a most efficient place that they're seeing growth in the marketplace. It's not investing in sectors. It's not investing in technology. They're seeing a tremendous amount of resources going to tax efficient investing. Well, what does that mean? That's simply a fancy term for the best way to invest while minimizing or reducing the taxes associated with your investment. How does that transpose into your investment or your portfolio? We'll illustrate it this way. Depending on your bracket, and again, this is all depending on how much you pay in taxes, what bracket you fall into. Your checking account, for example, if you have those same funds in a checking account and a tax-efficient account, well, the checking account might have to make 3, 4, maybe even 5% more to match the tax-efficient account because of the reduction in taxes. So think about that. That means that you don't have to be as aggressive. You don't have to be as dramatic with your investments. You don't have to put as much risk in your portfolio if you can reduce your tax footprint. So that's a huge step in the right direction, because one of the biggest things we get all the time from clients is, I want to invest, I want my money to grow, but I don't want to have a lot of volatility. Well, here's a great way to do that. Look at ways of reducing the tax implications. Now, there are a lot of different tools out there. You may have heard of things like mutual funds and ETFs, and you'll see a large swing now to ETFs from what they call their older cousin mutual funds, simply because of the tax efficiency of the portfolio. What do I mean? Well, whenever you have investments really grow by two ways. One is capital gains and dividends. Now, if you have an investment portfolio that is highly focused on dividends, that means that every year or every quarter you are going to have a tax bill. Period. Those are distributions from an investment, and whether you want them or not, they are reportable income. So what's going to happen when you have a portfolio that has a high dividend yield, there's a possibility that your tax footprint's going to be larger, versus if you have a portfolio that has a capital gain strategy And capital gain strategy simply means that there is no gain until you sell that portfolio. And at that point, what you made versus what you invested in will be calculated. So in theory, if you're not selling every year and you're leaving that portfolio alone, and it's a very targeted capital gain growth strategy, well, you're not going to be getting taxes until you actually need the money. So a lot of mutual funds, they traditionally have a funnel through scenario where all the tax liability goes to the investor. That's you and I. And they may be buying and selling portfolios all year. Where ETFs, exchange traded funds, don't sell on what they call a secondary market. So now there's the possibility that those taxes could be prolonged or pushed down the road, so to speak, or prevented from us, or what we use the term deferred, from having an impact on our financial status. So when you look at tax efficiency, that's one of the best things to look at. How is your investment set up? What is your investment strategy? If you're using things like mutual funds or ETFs, that's great. But what and how do they do their distributions? How is their capital gains or their dividends calculated? When do those distributions happen? That's one great way to look at your portfolio. Now, the ideal scenario, if you're trying to minimize tax efficiency, is for having you, the investor, involved in your investment, understanding when you're buying and selling. Some funds, for example, or some money manager groups will have what they call a lot of turnover. That means that they start out with 100 companies, so to speak. They like those, but throughout the year they change their mind and now they switch from 100 and they get another 100. Well, that creates churning, a lot of activity. And when you have a lot of activity in anything, that creates activity that can become taxable. But it can also be a resource for tax deductions. Now that brings us to our next strategy. It's called tax harvesting. And you may or may not have heard of it. But let's say, for example, you have a big portfolio and that portfolio has positions that aren't doing that well. Well, in theory, with these new tax provisions that may go enacted in the new tax law that is in Congress currently, you've got a scenario with those tax harvesting. So what we do is we sell the position. The position is below fair market value, therefore there's a loss. And instead of taking a little bit of that loss and having to defer it over the years, we might take the whole amount. So to again help you understand it, let's say I have a portfolio that's worth $200,000 and I made $25,000 in dividends this year, so now I've got a tax bill of $25,000. Well, I may have a position that is underwater. So of my $200,000, I may have another fund or equity position or an ETF that's about $10,000 under what I paid for it. I could sell that position, take that loss, and now pass that loss against my gain. So now my net gain is reduced. And then here's another beauty. If we wait for a period of time, you could then circle back and buy that same position if you still feel good about it at a later date and have that position back in your portfolio, but you've harvested. Does that make sense? You've actually reached out, you sort of cut the grass, took what you needed, and then let the rest grow. So tax harvesting is a great tool for many individuals. Now, this is where you have to have really a team of individuals that understand that. That's where your financial planning team really has to work closely with your tax and estate team. Because ironically enough, what you'll find is a lot of tax planners are inundated and very busy with filing taxes. That's it. Their hours are spent every day trying to calculate and put together your 1040, your corporate tax filing, your quarterly tax filing. They don't take a lot of time to drill down and see, are there ways that I can help my client reduce their tax footprint? But if you have a properly educated and schooled financial team, they'll be able to come in again, watching your six, looking at things that may have been overlooked, and help you understand, wait, there's some opportunities here. Never assume that your tax bill you're receiving from your investments has to be that way. Always look at a way legally to mitigate or minimize that tax footprint. And as we said, there are a lot of resources. So in recap, looking at where your income is distributed, do you have a high dividend yield portfolio or is a capital gain portfolio? Are you in mutual funds versus ETFs? Are you mitigating that tax liability by possibly tax harvesting your portfolios? See, these are all little things that make a huge difference in your growth model. And again, in previous episodes, we also talk about the use of trusts, restructuring your wealth into different accounts, mitigating the will so the tax footprints are lower by maybe having those assets held by an entity versus you. Now, we don't want you to leave this podcast going, my head's reeling, I don't know where to start. But a simple place to start is do a deep dive on your portfolio. Sit down with your investment professional, highlight what you have in place, articulate or tell them exactly what your goals are, and if they are competent and if they have the resources, they should be able to help you focus on how to do that. And then what we like to use, slow steps, moderate movement, you'll slowly become more efficient. And what ironically will happen is you'll see your assets start to grow more effectively. Another tool is looking at way you tax shelter your assets. So whether they be retirement assets that you can use, i.e. things like a 401k, an IRA, a Roth IRA, or TSA, tax sheltered annuities. They're another tool that you can use that are tax sheltered. Assets go in, taxes are deferred, and that allows that account to grow exponentially much quicker. You also could look at life insurance. There are resources out there where some of these life insurance contracts, because of the way they are titled, they minimize, in some cases, mitigate the tax liability associated with your growth. So I really want you to make sure you're taking your time. Now, I know it's a lot, and I know unfortunately what happens is you become overwhelmed, and you've got a lot on your plate already. I got to feed the kids, I got to work hard, I got to pay the bills, I got, focus on my new dreams, I got to build this business, I got to pay my employees, I got to read contracts, and those are all very critical components. But if you don't take the time now to maximize your potential, what you're going to do is slow your growth. And that's something that will become incredibly frustrating, but also compound over time. Now, another thing we're seeing going on right now is the new tax provisions for small business and the way the government has restructured its focus. Now, if you're familiar with the previous administration, there was a big push for renewable energy. So a lot of the tax incentives and benefits went to the renewable energy. So business leaders, for example, would focus their money on getting, let's say, solar panels for the business, maybe buying green cars for the office. But now there's been a refocusing of the tax provisions, and this refocusing has really been beneficial if you have a small business. One of the greatest provisions they're putting in place is called the QBI, and that is a deduction that is only available to sole proprietors, S corporations, LLCs. So we're not talking about the big big box stores. We're not talking about, Amazon and large organizations. We're talking about a tax deduction that is specifically for small operations. And what's beautiful about it is we're talking about a price increase of almost 23%. That's a huge deduction if you're a small business owner. If you've got the ability to write off 23% of your growth because you have a business, because you are a corporation, a sole proprietor, if the QBI becomes permanent with this new tax provision, that's a wonderful resource for you. Now, something else you want to look at, though, is the fact that this government is becoming very focused on the small business community. So here's some statistics that most people don't realize. Do you realize that 70 to 80% of the U.S. economy is driven by the small business? That's you, the person out there that has a great idea, opens a firm and has 10 or 15 employees. That's you that has a one-person operation. You drive the U.S. economy. So if we have a tax code or a tax provision that focuses now on the small business arena, what's that going to do to you and what's that going to do to the economy? Well, you're talking about an incredible expansion of growth, opportunities that we haven't seen in a long time. But it is critical that you understand how the companies and how the corporations are going to work in conjunction with the government's focus. So if we're getting away from the alternative green space, we're getting a lot of subsidies for emerging markets, but now you're refocusing that money on things like manufacturing, fossil fuels, corporate structure, and construction. Those are areas that money now is going to be refocused from a tax benefit perspective. You as a business leader have to make sure that your business model is falling into that, right? If you know that's where the government's fundings are going to go, that's where the tax benefits are going to go, that's where the subsidies are going to go, then you should focus your business on that. So we would recommend that now might be a great time for you to start a new business. If you've got an exploratory idea, entrepreneurial concept, something you've always wanted to do, now could be a wonderful time because you have several things in your wheelhouse. Tax efficient planning, so the ability to reduce the taxes impacting your growth. Sectors that you now know where the money is going to be highlighted. And keep in mind that many of these come from the 2017 Tax Cut and Jobs Act. They call it the Trump tax cut, but it was called the it was called the Tax Cut and Jobs Act of 2017. If those provisions become permanent and expand, you're talking a tremendous amount of wealth coming into an area that needed relief, especially after COVID, the small business arena. So those are great things for you to think about. If you focus on, again, the areas that those places are going to impact, you want to make sure that you're looking at it from a standpoint of this is an area that I'm going to invest in. Now, a reason we also see that this is a good opportunity maybe to invest in your business is one of the biggest expenses with a business is an employee. That's your cost. Well, the tax benefits are not going to only help the business executives, they're going to help the employees. You're seeing an increase possibly, depending on what happens in Congress, of 1,000 to 2,000 additional tax credits for individuals. So if you're filing as an individual or joint, your deduction may go up from, $15,000 to $32,000 depending on your situation. So that's a huge increase when you're talking about $1,000 to $2,000 increase on filing individually or filing joint, going from 15 to 16, or 30 to 32. Those are huge numbers. So now you've got a scenario that would play out where you've got the individual employee keeping more money, and you've got the company owner of the employee keeping more money. What's that going to lead to? Well, the hope is that leads to expansion. So the executive will have more resources to pay more to his employees and hire more people and reinvest more in the company. The employee will have more money in their pocket to pay for their quality of life needs and maybe have a little bit extra for things like going on vacation, traveling, buying something they've always thought about. Now, what's the ripple effect? And if you've seen in my podcast, I've talked about the ripple effect. Well, another stat for you is 70% of the U.S. economy is driven by consumer spending. So if you put more money in consumers' pockets, what's going to happen to the economy? There's been a huge debate about tax people, tax them heavy, tax them hard. That's the way the government makes its money. And that is an argument that goes back and forth. But I feel personally, if you give you, the individual, more resources, more money, your quality of life gets better, your mental attitude gets better, your physical health gets better, and your ability to buy and do things you enjoy gets better. And everybody wins because we still have taxation on sales. We still have revenue sharing going into the cycle. We've got companies that would then be spending more money in taxes because their profits go up. So there's a huge ripple effect that I think is something that, again, people overlook. And that's something that you really want to look at carefully. Now, another area with these new tax provisions is the possibility of the SALT tax or the SALT deduction, which is the state and local taxes, being reduced. So that's something that some areas are impacted more than others. If you live in certain states where you have state and local taxes, that can whittle down your income dramatically, as opposed to living in a state where there is no state income tax. So if you can start getting some federal relief, where now, whether you live in the north or you live in the south, you're starting to see your wages be somewhat comparable because there's some tax relief, that's going to do a lot to help your bottom line. So we see a lot of good things going on. We think, again, that it's mission critical that you take your time to understand those. Now, I know at the end of a long day, whether you're executive trying to build a firm, a large organization, you've got multiple aspects of businesses you're managing, or you've an individual managing your accounts and just your family, or you've got a scenario where you're trying to build something new, or an athlete or an executive, there are a lot of moving parts, and we're not going to say they're easy, but that's really why we say, we always bring this up in our show, is make sure you have your team. Get a good team of professionals that understand the breadth and scope of what you're dealing with, but more specifically, how those moving parts can translate to helping you be more successful. And ultimately, you're going to be very wealthy and you're going to be successful, depending on what you consider wealth. Again, I want to come back to that because I always say the word wealth and people go, oh, he just means he wants a Mercedes. No, we're talking about what your definition of wealth is. If you have more financial resources, your wealth could be, I want to be able to spend more time with the family on the weekend. I want to go for hikes. I want to give to a charity because I believe in trying to help the community. I want to help more people in my staff. Whatever your definition of wealth is, it takes action and it takes viable solutions to create that. So take your time. Make sure you're always working with your team and watching your six. Now, we're going to go to some DMs that we've got. So we'll be right back. All right, so we're going to go to our producer Grady. He's got some DMs. Grady, what you got?
How are you, Jason?
Good. How are you?
We're looking at some of these DMs here on Instagram and Facebook. We got Trump and his tax plan, Trump getting rid of income tax, Trump getting rid of tax on tips. I hear capital gain tax for cryptos, or Trump's getting rid of crypto tax. What's going on with all this Trump hullabaloo that I'm hearing?
So those are great questions. So basically, we have what everyone wants to call the one big beautiful bill, and that's just a fancy word for a tax revision that's going to put 2017 tax cuts permanently in place, and it's going to make some changes. So what I would say there is you want to look at the provisions of the tax bill, and we talked about it on our podcast earlier today, and how they impact the industry that you're in. So there is a big push to generate revenue for the small business sector. That's phenomenal. But it's very specific areas. So whether it's manufacturing, fossil fuel generated traditional companies, those are areas that you're going to see that revenue start to flood into if those tax provisions go in place. The no tax on tips, that's a no-brainer. You're talking about individuals that are already some cases in a low tax bracket, and 75% of the revenue is coming from them having to hustle to gain revenue from individuals, and it is very discretionary. They could work 10 days and get tips on 2 of those 10 days. So Trump's thought process is to have no taxation on that. There's another area they're pushing, no tax on Social Security. I think that's phenomenal. You've got individuals and their seniors now. Imagine what that's going to do for a senior who gets a 10 to 15% increase in their revenue because they don't get taxed. And frankly, Social Securities are already taxes. They got taxed before. Why would they get taxed again? So I think those are really good provisions if they go into place. You're talking about 2 areas that are hit the most that really don't have a lot of revenue. Servers aren't running around ultra rich, and neither are senior citizens. So you're talking about relief for those individuals. So I think it's a really good thing if it gets enforced. What else you got, Grady?
Brendan from YouTube had a question. He hasn't done his taxes in a few years. He's scared to go to a tax guy. Where does he start, and how will this impact his retirement accounts like his IRA?
So those are great questions. Particularly after COVID, I don't know what happened, but a lot of people got into fogs where they sort of forgot stuff, or they heard something on TV say you never have to pay your taxes. I think the best thing would be to do 2 things. One, first find a good tax professional. And why do I say that? Well, there's a lot of people that prepare tax out there, and maybe 50 to 60% of them are consumed with just filing taxes. So when you go in, they'll just tell you this is what it is, and that's it. But much like a doctor, get a second opinion. So go to a tax counsel, get somebody, ask him what his experiences are dealing with individuals, ask him what his age group is, what kind of sectors does he work with, get a little point of reference of who his clients are before you go to them. It's not something you want to do on your own, though, because if you do it on your own, there's a good chance that you'll run into some kind of snafu, and it might have an implication long term. That's a great question, though.
All right, another one of these DMs here. Let me look through them. We look like we got Sasha here. What income level can you recommend to move away from self-tax software, TurboTax, stuff like that, to a dedicated accountant or tax expert? Jason?
So I think the income level is less important. It's how you're set up. So for example, if you're a small business owner with 2 other companies, but you only made $50,000 that year, you may say, well, I only made 50 grand. That's not a big deal. But with all those different moving parts is where something like an automated software system might not work that well. It really depends on how structured you are. If you're a static employee and you made $2 million last year, but you're a W-2 employee with no deductions, software system will work efficiently because there's nothing that can be done. You didn't do any proper planning. You didn't do any tax harvesting on investments. You didn't do anything mitigating your tax liability. So you simply have a W-2 document. So I think it's less about income and more about structure. But again, that's where your planning team, whether it's your tax counsel and your financial team, should work together. Because like, for example, a lot of times during tax season, we're actually educating a lot of our tax counsel on the things that our clients are doing that they're not even aware of. So I think that's the route you want to look at. How complex is your scenario?
The more complicated your taxes are, start moving away from TurboTax. That's what
Correct. Well, the more complex your investments are, move away. If you have a scenario where you have multiple companies or multiple revenue streams coming in, that's when you're going to want to start having a team to help prepare your taxes. Good question. What else you got, Grady?
One more. It looks like here on taxes. This one says my business is getting bigger and I'm starting to look for outside investment. Is there a rule of thumb why I should be an LLC or an S corp or any other such business entity? he's looking to, I guess, get some outside investment for his business here.
So you have two things you're discussing. One is what we call seed money. So it could be in the form of venture capital or angel funding. And you want to make sure you understand the differences between those two because they're dramatic. And the second is, should your company be restructured because you're thinking about funding? Now, corporate structure is critical when it comes to partnerships or any kind of funding because it protects you and protects the individuals and it protects the organization against liability. It also mitigates or helps you control the amount of control you want. There are a lot of, what we call horror stories out there where individuals had companies, they wanted some venture capital or seed money, they didn't properly structure the contracts or the designs of the organization, and what ends up happening is the entity that came in and provided them capital simply took them over. We call a hostile takeover, or belligerently pushed them out or took over the operation by giving them a couple of dollars here and there while they knew that that seed money would probably grow 40, 50% greater than what they offered the owner. So I think the corporate structure is critical for how you want to protect your interest and how you want to protect the tax liability, but you also need to understand what the difference between the type of resources are, whether it's venture capital, whether it's angel funding, whatever those your nuances are, you want to know because those have a dramatic difference in their terminology and the way they're structured. So those are great questions.
Jason, that looks like all the questions.
All right. Wow. Thank you, Grady. Appreciate it. So anyway, we're delighted you tuned in the episode this week. Watch Your Six. We hope you found it beneficial. Again, as always, go to our YouTube, Spotify, or every place you find your podcast. Share your thoughts. Feel free to DM us if you want on the social media or email our office directly. We'd love to have those questions on upcoming shows. And I'm Jason Edwards. Thank you for watching Watch Your Six.